Good morning. Welcome to our regular second Saturday webinar. We will go into the presentation now. (2023) year started on a good note for global asset classes. Whatever asset class you see, everything has rallied since the start of this year. Even the recession feared countries in Europe, they are doing very well. Germany index DAX from 14,000, it has gone to 15,000 in the last 10 days. Almost 7-8% rally we have seen in the German index. US market also rallying very sharply. Other than equities, if you see other asset class, gold, metals, base metals, ferrous, then even cryptocurrency, almost all asset class has rallied in the last 10-12 days, barring our Indian market. One of the reasons why all asset class has gone up is that the dollar index has weakened, which indicates that the dollar is losing steam. Whenever that happens, generally asset class used to do well. Most of the asset class used to do well. And it also indicates that some risk on trade has started. Yesterday night, cryptocurrency almost across the board has rallied very sharply. Now Bitcoin just $16,000 few days back, yesterday crossed $20,000, indicating that some risk on trade is going to come. Only exception on this asset class is Indian market. Indian market was not doing well since December last week. Historically, if you see that the December last week and January first week, our market used to do well, but this time our market has seen very sharp correction. The main reason for that is the continuous selling by foreign institutions. Even yesterday also they sold almost 2,000 crores. The last 2-3 weeks they have sold almost near to 20,000 crores worth of shares in cash market in our here in Indian markets. They have sold. Generally, as I said previously, the December last week and January first week, most of the FIIs will go on for a holiday tour, and their action will be very less. But this time it was exception, and they were continuously and actively selling in our markets. The main reason they are telling is that our market is overvalued relative to other markets, and so some rebalancing is happening where they are shifting some money from our Indian market to other markets where the valuations are less. One of the market they are telling is that China, they are telling where money shift is happening from Indian market to Chinese market. As you all know that China has reopened its economy in the last 2-3 years since the COVID started. Chinese economy was on and off mode in order to prevent COVID, and stringent regulations were there. A lot of pockets of lockdown were seen throughout China in the last 3 years. Now Chinese government has completely relaxed that one, and they have removed all the restrictions, COVID restrictions. So initially, a lot of cases are coming up in China, and 2 weeks back there was a panic and fear in the global markets that Chinese COVID cases may spread to other countries, but there is no talk as of now. So because of Chinese economy opening up, some foreign institutions, they are moving money from overvalued Indian market to other markets where valuations are attractive. So relative to global markets, Indian market has significantly underperformed since the start of 2023. And other important thing what we see is that the commodity stocks are doing well. So on one side, we are all talking about recession because of rate hike and other things. But on the other hand, commodity prices are very stable, and in fact, they are going up. Historically, if you see that whenever recession talks come, the first asset class that used to get hit is the commodities, because when there is recession means naturally the consumption of commodities will come down. But this time it is very surprising to see that commodities are very stable, and in fact they are going up. And last presentation also I put a slide on steel, that in spite of weak performance by steel companies and in spite of all this recession news, steel stocks did not crack. And in fact, as Jindal Steel and Power and JSW Steel all came to their lifetime high in spite of all this recession talks. So commodities are very stable, and there is a hectic buying happening in gold price and gold and even the cryptocurrencies also going up. The only positive news as of now we see in our market is the strong SIP flows. SIP flows continues to remain strong, and it is at all-time high. 13,500 crores monthly SIP flow is coming. That is what balancing the FII outflow. So whatever FIs are selling, it is balanced now by the mutual fund flows. And if you see the index, almost 2 to 3% fall in index is there between last meeting and current meeting. Nifty and Sensex around 3, even mid cap also down by 3. Small cap done relatively well at minus 2.3. And this is the global market performance last year 2022. And if you see that Indian market has relatively done well. Nifty has gone up by 5.7%. Whereas Sensex around 4% it has moved up. But the worst performing market, if you see, is the Nasdaq, down by around 35%. And some of the stocks, that is FANG stocks, where it consists of Apple, Amazon, then Netflix, Alphabet, all these stocks, that ETF is down by almost 33%. This is the set of stocks which was told that it is an evergreen buy and they will continue to do well for the next decade. Like that it was told last year. But if you see that it is this is the stocks, these are the stocks which fell the most among the index. FANG ETF down by almost 33%. And individually, if you see that many stocks were down, much famed stocks were down very sharply. In fact, Tesla in the last month, in December month alone, it fell by around 40%. From $200, it fell to $100. But if you see on a 1 year basis, from $400, Tesla fell to almost $105. From there, it has bounced back a little bit now. And 75% market cap eroded in Tesla stock, which is a much hyped stock where everyone were buying that one. And surprisingly, if you see that the FTSE index, which is the London index, it is up by 1%, where we talk about all recession, which has hit this UK. And that index did not fell much. And DAX is down by around 9. Other European markets down by around 9%. DAX is down by 9. Then France is DAX is down by 12. Then France is down by 9%. And one of the best performing index is the Turkish market, which is up by 180% because of the huge devaluation of the rupee. The index appreciated, not the rupee, the Turkish currency, because of huge depreciation of Turkish currency. That market did very well, almost 180% up. Overall, 2022 is not a good market globally. India just managed to show some gains. This is the Sensex historical yearly return. It's a very interesting chart. From 1981, every year the return has been plotted, and if you see that there are many periods of consistent positive returns. Even now, if you see from 2016 to 2022, continuously 7 years, the Sensex has given positive return, and previously the Sensex will continue 7 positive returns. If you see that 2002 to 2007, where Sensex continuously has given 7 years of positive return. If you leave aside that over continuously we did not see positive return more than 7 years. So whenever 7-year return was there, one correction has come, and we have to see 2023 how it pans out. But if you see historical data, then we should have a negative return in 2023. And also, if you see the decadal return, actually 2001 to 10 was one of the best decade we had. Almost 18% return it has given. 1981 to 1990, also the index Sensex has given 22% return. But during that period, the participation was very less. Most of the investors do not know about the market. Only Gujarat and Bombay and in Calcutta and Delhi, there were some people were just a handful of people who were investing at that time. So the best return where most of the investors participated was between 2001 and 10, where the Sensex has given almost 18% return, 17.9% the decade return was. Between 2011 and 20, it is just 8.8% return, and in current decade 21 and 22, almost 13% return it has given in the last 2 years. If you see the market, one very important observation you will get it, that what is happening in the market, mid caps and small caps, they are not falling much, but some of the stocks, if you see that, they are consistently falling. Which are the stocks? The stocks which are having very high PE ratio. If you observe it closely, we can find that even yesterday the index was up, whereas some of the companies like Asian Paints, they underperformed the market. Some of the stocks which did well between 2018 to 2020, that mainly the Asian Paints, the paint stocks, Asian Paint, Berger Paint, Pidilite. Then in financials, if you see Kotak Mahindra Bank, then Bajaj Finance, these are the stocks which did very well between 2018 to 2021, and they outperformed index significantly. And these are the stocks which were trading at very high valuations, almost 70p, 80p it was trading for manufacturing companies, whereas on financial sites they were trading around 3 to 5 times book value. If you see Bajaj Finance, they were trading around more than 5 times book value it is trading, whereas the traditional PSU banks shares, they were trading around 1 and less than 1 times book value. So stocks which were trading at very high valuations, they are seeing a lot of selling. The other group of stocks which are seeing a lot of selling is the new generation financial stocks. The new generation stocks like Zomato, like Nykaa, Policy Bazaar, these are new generation stocks, Paytm. These are the stocks are also seeing a lot of selling. And what it clearly indicates is that high PE shares, which were doing very well during 2018, 19, and 2020-21, 4 years they did very well. And many people were telling at that time that you should not see the PE ratio for buying the shares. You should see only the quality of the company, quality of the earnings, and you should buy and forget it. That was told at that time, and these stocks were continuously going up. In fact, some of the companies like Asian Paints and all, when we felt that it was highly overpriced around 50 PE, 60 PE, it went further and it went to 80 PE like that. And we completely missed that these type of shares because of overvaluation. But it was keep on going up. But now the situation has turned around and the cycle has turned. What is happening now? All these stocks have started corrected. And if you see, many of the stocks are down by 20%, 30% from the peak. Still, there is no sign of buying happening. Yeah, and the valuation reset, which most of them were telling that whenever interest rate starts going up, the high PE stocks used to correct a lot, and that has started now. And we feel that the valuation reset will keep on going for some more time till the valuation become reasonable. So when valuation will become reasonable, either earnings has to improve substantially or price has to come down. Either one has to happen. till then we will see some sideways movement in all these overvalued stocks. And we all know that interest rates and PE are inversely correlated. When interest rates are down, then PE used to go up, price earning ratio used to go up. Similarly, when interest rate starts going up, means then PE naturally has to come down, and they are inversely correlated, interest rate and PE ratio. And now we all know that interest rate has gone up very sharply, and that is the reason why the valuation started coming down, and that may continue for some more time. And some of the companies where the growth rates are tepid, but valuations are very high, and we may see a long consolidation in this type of stocks, in spite of the quality label they are enjoying. And some of the stocks like Page Industries and all, from 53,000, now it has corrected to 40,000, almost 25% corrected. These are these are the stocks which used to come under coffee can portfolio, where the valuation doesn't matter, whereas only the quality matter. But now the cycle has changed, and we have to see how long it will. These stocks will underperform in order to become fairly valued. And you also that many of them would have been investing in many mutual funds, and you can clearly see that in the last 1 year, many mutual fund has done well, and many mutual fund has done very badly also. And if you see some of the funds of Axis Mutual Fund, they have done very badly, because they mainly own all this high quality companies with high PE ratios. If you see their schemes, they were owning the DMart, Bajaj Finance, these type of stocks they were mainly owning, where the PE ratio is extremely high, and they have significantly underperformed the market in the last 1 year. On the other hand, some of the mutual funds like HDFC, Nippon, they were doing well, because they were mainly owning value stocks, metal stocks, PSU stocks like that, and that part has significantly outperformed the market, and that is why that mutual fund is doing well. So every mutual fund has its own style of investment, and they have their own period where they will do well. HDFC and Nippon did very badly between 2017 to 2021, whereas the Axis type of mutual fund did very well during that period. Now the cycle has changed, where Axis is doing badly, whereas HDFC and Nippon are doing well. Now we are seeing that suddenly many stocks are going up. The reason they are telling is the Chinese economy is reopened now, and that will have huge positive impact on the market. But I feel that it will have a mixed impact on the stocks in our market. Because China reopened, because of Chinese lockdown, many Indian companies got opportunity to export to US. One important sector which got benefited because of Chinese lockdown was the textile sector. Textile sector did very well in 2021 and 2000 first half of 2022, mainly because of Chinese lockdown, where Indian companies grab a lot of market share in countries like US. Now when Chinese economy completely opens up, means what will happen is that China will try to grab the last market share in exports market. They may price it very attractively, that and their main motto will be try to grab the last market share. So in that way, if you see that some of the sectors like textiles and chemicals may see some negative impact because of Chinese market opening up, and metals, initially it will be positive, but as time progresses, I feel that metal sector also may see some negative impact, as China will start exporting a lot of metals to globally, and it will be positive for consumers, because it will be disinflationary, because Chinese products are very cheap, and whenever cheap products are exported to globally, means naturally the price will come down, and it will be disinflationary for consumers. So the China reopen impact, as told in media, that it will be hugely positive. We have to take sector to sector decision, and it will not be everything will be positive for us. it may be something also will be negative. Some sectors may also will be negative because of Chinese economy reopening. And this is the very important slide. I took this from the Nirmal Bang Institutional Equities Research presentation. For educational purpose, I am showing this. If you see that the market is coming down, the main reason why market is coming down globally is the recession fear. Why there is recession fear? Because Fed is increasing interest rate to tame down inflation. So historically, if you see that US has seen 7 recessions since 1970. Among them, 3 are Fed-induced recession. That means Fed intentionally wants to slow down the economy to tame inflation. The other 4 are which has happened by itself. For example, 2008 and 8-9, a huge recession came because of global financial crisis. The recession came because of global financial crisis. It is not due to any Fed action. Similarly, 2020 US recession came. That is mainly because of the COVID US recession came. And if you see in 1974-75, a US recession came. It was a 5 quarters of negative growth, mainly because at that time some major decisions were taken. OPEC oil embargo, a huge rise in crude oil prices was there. Then a gold standard was removed. Like that, many important activity happened at that time. And at that time also US recession came. Apart from that, there are some recessions which has happened mainly because of Fed action in order to tame inflation. In 1970, US has seen one recession because of high rise in inflation. They increased the interest rate. 1970, 1980 also there was a sharp increase in interest rate to tame inflation. 1991 also the same thing. Now the Fed is increasing interest rate in order to tame inflation. But if you see that Fed induced inflation, when you compare with Fed induced recession, as well as the recession happened due to other events, if you see that whenever there is a Fed induced recession, the time was very short, as well as the recession was shallow. In 1970, it was just negative 1 quarter of recession, and average decline was just 0.17 in US economy. 1980, 3 quarters of recession, but the depth of recession is very shallow, minus 0.81. 1991, only 3 quarters of recession and minus 0.53. And just shallow. When you compare to other items, the recession happened due to global economic crisis, or due to COVID, and due to OPEC oil embargo. The fall in US economy is much lesser. So right now we are seeing the same thing, that US recession is expected, and it is a US Fed induced recession. So what we are expecting is that the recession will be very, very shallow and short-lived. The other important thing happening in our market on equity, on liquidity front, is that the interest rate has gone up very sharply in the last 6 months, and it has made very attractive for fixed income investment. The other asset class, if you see the other asset class, kept aside equity, the other asset class, their fixed income is doing very well. Gold returns are gold metals. Historically, if you see, Indians invest in 4 asset class mainly. One is the fixed deposit, the second is the real estate, and the third is the precious metals, mainly gold. People used to invest, and the fourth is the equity. The last 3-4 years, what it has happened was that the interest rate was very low. Gold price was not moving up. So it was told that there is no alternative for people to park money, and that has forced many of them to come into equity markets through mutual funds or directly. By saying that there is no alternative, equity is the only alternative available to park money. But now the situation has changed. The interest rates are very attractive now for especially for senior citizens, and gold prices also going up. Gold prices are going up for two reasons. One is that rupee has depreciated a lot. The second thing is that globally also the gold price is going up. So now the competition to equity inflow has come up. Unless the market performs very well, then there is a very good scope for some money going into other asset classes, mainly fixed deposits and gold. What used to happen is that the money which has come into the equity market, they will stay into the equity market, unlikely to go out. But the incremental money that which should have come into equity market, that may go to other asset class. If you see that the bank deposit rates, this is the bank deposit rate of SBI, and if you see that almost in the last is in 2022, almost 175 basis point the interest rate has gone up. This is for 1 year deposit rate. If you take for 2 year deposit rate, a senior citizen can get up to 7.5% interest rate in a very safe bank like HDFC Bank. If you see NBFCs, AAA rated NBFCs, Mahindra and M&M Finance, Bajaj Finance, Sundaram Finance, they are all giving 8% interest rate to senior citizen. Nearly 175 basis point to 200 basis point up in the last 1 year. So 8% interest rate is a reasonable interest rate for a senior citizen, and definitely it will give some competition to the equity flows, because last 1 year Nifty and Sensex has gone up by around 4 to 5%. And suppose if current year, if the returns are very muted, means then people will start thinking that if I put that money, the same money in bank, I would have got 5 to 8% more return than equity return in the last 2 years. And if that starts coming, means naturally some incremental money will start moving into the fixed income group. So this year equity has to do well, otherwise the fixed income asset class will give a big challenge to equity inflows. This is the gold price chart. The other asset class which is doing very well, the top one is the international gold price. It hasn't gone up much. If you see in the last 10 years, if you see from 2013 to 2023, it has gone up by 12% internationally. The gold price has gone up by 12%. Whereas in India, from 90,000, it has gone to near to 1,60,000, almost 75% return. The gold has given in rupee term, whereas internationally it has given by a return of 15% in the last 10 years. Why in rupee term it has done very well is mainly because rupee has depreciated very sharply in the last 10 years. Even if you see in the last 1 year, the gold price is lower than what it was seen 1 year back in the international market, whereas in Indian market it has touched an all-time high. Actually, this chart I took it few days back. Yesterday, Indian gold in Indian rupee has touched all-time high, mainly because last 1 year rupee has depreciated by 11%. That has given additional return to the gold price, those who are owning gold in the Indian market. Why gold price are going up internationally very sharply is the central banks worldwide, they were buying the gold very aggressively in the last 1 year. And if you see the central banks, all the global banks, Chinese central bank, Indian a central bank, RBI, most of them were bought gold in the last 1 year, and it is one of the highest bought by central banks in any single year in the last 15 years. If you see, means that is the reason why gold prices were going up internationally. Additionally, in India, if you see that rupee has weakened by 11%, that has added to the performance of gold. My feeling is that if equity market has to do well in current year, otherwise we may see significant portion of incremental money may move to fixed deposits, which are risk free, as well as some money may go to gold also. Now budget is nearing, that is on February 1st, budget is coming. Whenever budget is coming, 3-4 main things media used to discuss. Unfortunately, this time, since market is on a sideways movement, we are not seeing much discussion on the budget front. Historically, if you see, we may see huge pre-budget rally will happen generally in the month of January. That is 1 month prior to budget. But almost 2 weeks has passed. Till now, there is no talk of pre-budget rally, and only 2 more weeks is left. At least I feel that whenever the foreign investors selling stops, we may see sharp up move in our market till the budget. So when budget comes, 3-4 things we used to discuss in media. The one is the what would be the capex of the government in the budget. The second thing is the fiscal deficit, how much they are going to borrow. What is the PSU divestment? These three they mainly used to discuss in the media. They used to do a lot of debate whether government will increase capex or will reduce capex. Will government will spend a lot of money by borrowing more. Then what will be the PSU divestment? Then the other important thing they used to talk about is the change in taxes, direct taxes. Already we are hearing that the government may change may tweak the taxes for asset classes, various asset classes. Right now, if you see that for equities, 1 year is the holding period to be eligible for long-term capital gain. For real estate, it is 2 years. For debt mutual fund, it is 3 years. If you hold more than 3 years, it will be treated as a long-term capital gain for debt mutual funds. For real estate, if you hold more than 2 years, it will be treated as a long-term capital gain. Below 2 years, it is set as a short-term capital gain. For equities, it is 1 year. Below 1 year, it is a short-term. More than 1 year, it is a long-term. Gold, 3 years. If you hold more than 3 years, it will come under long-term. Below 3 years, it is a short-term. So each asset class has its own holding period to be treated as a long-term capital gain. Right now, there are a lot of talks going on that government may tweak the holding period and may bring everything into same period to be eligible for long-term asset class. Only in budget we will come to know. Till then, we don't know what government is going to do, and some of the underperformance of our market is also related to this rumor that government may tweak the holding period of long-term capital gain for equities. Right now, it is 1 period. They are telling that they may take it to 2 years or 3 years to be eligible for long-term capital gain. So till budget comes, we do not know what is the government intention. And the other thing we used to discuss about in the budget is the government capex, because capex always lead to multiplier effect in the economy. And if you see that in the last 4 years, the government capex has gone up very sharply. In GDP terms, if you see that from 1.5%, 1.75% of GDP spent for capex 3 years back. Now in current year, it is expected to be around 3%. The same thing is likely to be maintained for next year also, as far as capital expenditure is concerned. Fiscal deficit, fiscal deficit was stable till when COVID came, but when COVID struck, fiscal deficit went up very sharply. Now it is gradually coming down, still at a much elevated level. very high level. The combined state and central fiscal deficit is almost 9 to 10% in current financial year, and government may bring it down gradually. In the current budget, I am not expecting that government may bring down the fiscal deficit very sharply. They may reduce it gradually, but still it is at a very elevated level. So what is the impact of high fiscal deficit? When fiscal deficit is high, government will borrow more. When borrowing is more, means naturally the interest rate will remain higher, and government keeps on borrowing more, means rupee will also depreciate, because the more you borrow and spend, higher the inflation as well as higher the interest rate. PSU divestment, as expected, if you see that in most of the year, the government has missed the divestment target. And if you see in the last 4 years, at least till January, the in current financial year, government could not able to achieve the divestment target. Most probably the current year also they will not achieve the divestment target, and only because of LIC IPO, some amount has been gathered in by the government in the current financial year. Last 2 years, it was very pathetic, where the target was almost 2 lakh, 1.5 lakhs, but actual achieved was not even 20% of that. Only in 2 years, the last 9 years, if you see, only in 2 years, government could be able to achieve what they have told in the budget. That is also mainly of two reasons, two important reasons why they could be able to achieve. One is that HPCL was sold to ONGC, so on that year government achieved the divestment target, and another year they sold REC to PFC, which is nothing but selling government stake to another PSU company, whereas government got money in that process, and because of that, government could be able to achieve the divestment target. Apart from that, not even a single year they could be able to achieve the divestment target. FIA activity, if you see that they are continuously selling. Last year FY22 they sold 18 billion, and FY23 almost 3 billion they have sold it. And if you see that till November the figure was almost flat, but in December second week onwards the selling started, and it is continuing till January second week. And suppose if global market continues to do well, and if all asset class are doing well, and risk on trade starts coming in, means naturally the FII selling will stop. If FII selling stops, means I am expecting the market to see sharp up move, at least till budget. Mutual fund flows, it is the SIP money which is rescuing 13,500 crores, which is all-time high. And if you see the lump sum, it is 7,300 crore. That means the net, if you strip aside SIP contribution of 13,500 crore, then what will happen is that actually there is a net outflow of around 7,000 crores in the equity market. SIP inflow is 13,500, whereas the net inflow is 7,300. That means there is a net outflow of nearly 7,000 crores, 6,500, 7,000, 6,000 to 7,000 crores outflow from the lump sum. Last month also the same thing happened. SIP inflow was there, whereas the equity net inflow was much lesser, which means that lump sum money people are withdrawing it. Q3 results expectation. Now Q3 results have started coming in. All the 4 IT major companies has come up, and if you see the sector wise, what we are expecting is that banks and hotels will show very good performance. These two sectors, generally the hospitality sector, which are related to travels, these companies will show very good results, and banks also will show very good results. Monday, Federal Bank is coming out with the results. I am expecting a very good results from Federal Bank. And banks overall will show very good results. Similarly, the hospitality sector will also show very good performance. IT companies, if you see that 4 large cap IT companies came out with results, and it is better than expected. In all the 4 cases, it is better than expected, and mostly revenues were in line, and profitability ITCS was slightly lower, and other companies have shown slightly above expected profits. And I and I expect IT companies will remain defensive. Pharma, it will be a mixed bag. The bellwether Divis Lab, we are expecting sharp drop in profit and revenue, because they mainly earned profit because of COVID drug. Now that tailwind is no longer exist. So Divis Lab results is not going to be good, whereas some of the companies like Zydus and all, I am expecting the results will be good. So pharma will show a mixed performance. Consumption, because of very high inflation on volume front, they may disappoint, but profitability also there may be some disappointment on consumption front, mainly because of high inflation. Metals, we are going to see quarter on quarter good improvement in profitability, because metal prices have started going up, and if metal prices remain strong, means naturally all the metal stocks will do well in coming days. So the result season, which started now, will continue till February 2nd week, till February 14th. And Indian IT sector, almost 4 large cap companies has come out with the results. TCS, Infosys, HCL Tech, Wipro, all the 4 companies has coming out results, and results looks decent. When you compare with the stock prices, which it underperformed in the last 1 year, results look decent, and growth rate may fall in coming quarters, mainly because of likely recession in US and Europe. But what we feel is that the price are very attractive now, that the significant price correction is very unlikely in large cap IT stocks, and likely to be range bound another for 1 quarter or 2 quarter, but significant price correction very unlikely for large cap IT companies, and someone who want to buy an IT company means good time to gradually accumulate now. And the second important thing what we see in the IT results is that attrition rate has come down, has started coming down, which is very positive on margin front. I feel that, because last 2 years most of the IT company recruited many employees by giving very high salary, and once the attrition starts coming down, means what will happen? The pricing pressure, the salary wages pressure, that will start coming down very quickly. We all know that Indian big IT giants, they know how to deal with the employees, and they know how to adjust the salary. What they used to do is that the fixed salary will be there, then the variable pay, which is the other part, that an IT employee used to get 2 salary. One is the fixed salary, the other is the variable salary. Whenever the attrition starts coming down, immediately they will start cutting the variable pay, which means that it will be margin incremental for the major IT companies. They know how to keep the cost under check, and they have learned in the last many years. And fall in attrition rate, I feel is very positive for the IT companies. Some of them are saying that the very less employee addition is negative for IT companies, because the future outlook is bleak. That is why they are not recruiting. But I don't feel like that. I feel that the employee addition will be less. Employee addition will boost their margin, and what will happen? What will happen if attrition rate further comes down? Is that they will start reducing the variable pay. Big IT companies like Microsoft and Alphabet, they are cautious on near-term outlook, but Indian IT company is altogether different set of company, the products, different set of services they do. And one can buy the IT company price-wise, no major correction I am expecting. Maybe range bound to positive the next 3 to 4 months. That's what my expectation is on large IT companies. The other big positive for all these large IT companies that they used to give lot of dividend. They are cash printing machines. A lot of free cash flows are generated, and they either distributed through dividend or through buyback. Infosys is doing buyback, 9,000 crores buyback. They are doing it almost 50,000, 4,500 crores. They already bought it from the open market. Balance they will buy in coming days. And TCS has declared a 75 rupees special dividend plus interim dividend, and next week it will become X date. HCL Tech, every quarter they are giving 10 rupees dividend, and so the dividend deals are very attractive. So large cap IT companies, the dividend deals are attractive, downward risk is less, and one can gradually accumulate it. The consensus view on the market, if you see in the last 1 month, whoever fund manager comes in TV, whether it is mutual funds or foreign institutions or other big investors, whoever coming into the market, they are echoing almost the same voice. What they are telling, 2023 will be a tough year and very difficult to make money. That's what they are telling. Mostly it will be a year of consolidation and sector rotation, and no major money we can make in 2023. That is what they are telling. And US Fed will not cut rates throughout 2023. And the valuation derating, which I said it in the initial comments, where the PE ratio of a large quality companies that may fall, that will keep on happening. That is what most of the fund managers are telling. US may see mild recession, and a recession will not be deep, it will be mild, and Russia-Ukraine war will prolong. It will not stop now. It will keep on happening for more months and years. That is what everyone is expecting. And incremental retail money may shift to fixed income. That because the interest rates are attractive, some incremental money may move to fixed deposits instead of coming to equities. That is what this is the consensus view. If you see any fund manager, they are telling the almost most of them are telling the echoing the same opinion. But we feel that 2023 will not be a disappointing year, because already everyone is expecting it is going to be bad. Even if it bad comes, it is not going to disappoint you, because our expectation is very less and muted. That is why even a slight positive comes means that then a market will do well. Anything can happen. There is a possibility of Russia-Ukraine war stopping. Right now, it is not in the price. And suppose any news comes, means immediately market will go up very sharply. Similarly, if you see that the positioning is also very less. If you see IT sector, many fund managers are extremely light in IT sector, and some of them even coming in TV and they are telling that we are having zero position in IT sector. Suppose some positive comes on that front, means definitely it will push up the index, and we are going to see plenty of stock specific action, because what is going to happen is that the high PE stocks we will continue to see is the down sideways movement or downward selling pressure. On other hand, that money may move to other stocks, and that stock will do well. And similarly, if you see the pharma stocks, majority of the pharma stocks are corrected, and pharma index has given negative return last year, and valuations looks reasonable, and that sector may do well. Similarly, IT, the positioning is very less, and if any small positive comes, means then IT sector also will do well. So sector rotation is going to happen, stock specific action is going to happen, but overall it is not going to be a disappointing year. That's what we are expecting. Events to watch: Union budget is on February 1st, and it will be important. Mainly this time, what market will be focusing is the any change, any tweak in the folding period for long-term capital gains. Any tweak in the capital gains they are going to make, that will be closely watched. Suppose if it is kept as status quo, means then we may see very sharp rally in the post-budget session. So that will be closely watched. Tweak in the capital gain structure on equities, that will be closely watched. And on February 1st also we are having US Fed meeting. Now US inflation is continuously coming down. It it is expected that US Fed will hike rate by 25 basis point on February 1st. Till now, in the last 4 meetings, they have hiked by 75 basis point. But on February 1st, US Fed may hike by around 25 basis point. So these two are very crucial events to watch. Apart from that, the quarterly earnings season that will continuously happen till February 2nd week. So the very active events are ahead, at least for the next 3-4 weeks, till the result seasons are over. So that's it for this second Saturday presentation. Now we will move into the recommendations. So 5 stocks we are recommending this in current meeting: Airtel, Infosys, GSPL, National Aluminium, and Reddington. So these are the 5 stocks we are recommending. The first stock we are recommending is the Bharati Airtel. So what is happening now in the market, if you watch closely for the last 1 week to 10 days, is that daily some institutional report, foreign institutional report will come. They will downgrade the stock in the morning. Immediately that stock will fall 3%, 5% like that. And in the last 1 week, if you see that Bharati Airtel is one stock where a foreign institution downgraded and the stock fell very sharply. And we feel that because of FII, they want to exit. They are bringing out one report, negative report on that, and then they will sell the stock. Similarly, Cipla also fell one day because Jeffrey downgraded the stock. Like that, daily some reports are coming by foreign institutions. They are selling it based on the report, and stock will come down. We feel that Bharati is reasonably priced now, and 5G is going to come, and in this correction, one can buy the Airtel, Bharati Airtel. Infosys, as I said, that many people are extremely negative on IT stocks, and price also has corrected, and we feel that Infosys is a decent buy, at least on a risk reward basis. We don't expect the stock price to fall much. At worst, it will be range bound, but we are not expecting the stock price to fall. So the risk reward is very favorable. GSPL, Gujarat State Petronet, the recently one PNGR, that is the piped natural gas regulator. They have came out with a new regulation, which is not bad for the company like GSPL. And moreover, GSPL has completely turned into cash positive now. 3 years back, they took 4 years back, they took almost 3,000 crores debt to buy the stake of Gujarat Gas. Every quarter they paid it. Now that debt has been completely returned, and there is no debt. The balance sheet has become very strong, and the valuation also very reasonable. GSPL is the promoter of the Gujarat Gas. So they have the stake in Gujarat Gas also. And if you see the combined valuation, looks very cheap. So one can buy with GSPL. National Aluminium, the dollar is weakening. Globally, all metal prices, commodity prices are going up. And National Aluminium looks reasonably valued, and one can buy National Aluminium. The last one is the Reddington, which is in the business of hardware like printing ink, like that. They are doing it. They have also have an IT division also. The company is giving very good dividend. They have excellent cash flow, which is distributed as dividend. Professionally managed company, and one can buy it. So these are the 5 stocks which we are recommending. And the next last month review, if you see that the 5 stocks we have given: Bank of Baroda, one can hold on; GSFC also one can hold on; Cement also one can hold on. All the 5 stocks is a hold for us. Rallies, Wednesday results are coming. If results are bad, stock may come down a little bit, but risk reward, if you see that for next 2 years, it is extremely attractive. One can hold on. If Wednesday results are bad, the stock may come down. If it comes down, means you can add more in that fall. So overall, the portfolio has given a negative 1.52%, whereas Nifty is down by 3%. So that is a review of it. All the 5 stocks are fold. Now we will see technical presentation. It will be taken up by the Patwanaban. Please be online. After that, we can have the Q&A session.
Good morning. The Nifty has been trading in an upward channel from last June till December. The upward channel has broken around December 23rd. So now it's drifting downwards. So with this view, the Nifty will consolidate in the near term. If it has to again come into the channel to be bullish. These are the support and resistance for the Nifty in near term. The next support is 17,760. The Nifty is trading around this level now. The strong support is 17,400. In the resistance view, 18,250 is the next resistance. Then 80,450 and all-time high of 18,900. Even if you plot the Fibonacci retracement level, the next support is 17,460. So 17,400 to 450 levels will be a good support level to watch. So most probably, even if market correct in the near term, the market will bounce back from these levels. So in the upward and the resistance level with Fibonacci levels 18,000 and 18,900 are the next level to watch. And one bullish pattern is emerging. It's called flag formations. So with the flag formations, if it breaks these levels and if Nifty trade above 50 points or 100 points, then it will be bullish. So the formation has to be confirmed in next 1 or 2 days. If it's correct, if formation happens to be correct, then it will be very positive sign and Nifty will hit new highs in the near term.